If you check the news in the past few weeks, you've probably heard the terms short selling and short squeeze quite a lot in relation to the big story of GameStop. And in today's video, we're looking specifically at these two terms to try to understand what they actually are and how they actually work. So let's start by looking at short selling. When we refer to short selling, what we mean is that an investor borrows shares of a stock believing it will decrease in value by a set future date, which is known as the expiration date. The investor then sells these borrowed shares to buyers who are willing to pay the market price for the shares and hopes, as we said, the price declines. So that when they have to buy it back, they do so at a lower cost. And this difference, so the difference between what they bought them for at the borrowed rate and then buy them back to return them, is the difference in the profit that they make. So in this case, in this fantastic graph you can see here, they borrow them at $100, they buy them back at $20, and that difference, so $80, is a nice profit they've made. A very important point to consider is that there's technically no ceiling on how high a share price can go, and so there's technically no ceiling on their loss. There's potential infinite loss for these short sellers. The example is here. We've got the legal update is trading on this imaginary market at a nice $500 per share. The investor thinks the price will drop and so borrows 10 shares from the broker, who then sells it for the current market price of, as we said, $500. Now, if the stock goes down to $300, the investor could buy the 10 shares back at this price, return the shares to the broker and net a profit of $2,000, because this is the difference between the $5,000 they paid and the $3,000 they paid to return them. But, and that's a very important point, if the 2-year price rises to, let's say, $800, the investor would lose $3,000 because they paid $5,000 initially to borrow them, and now they have to pay $8,000 to return them to their broker. Another important point to consider is what a short squeeze is. So the basics here is that the price of a stock rises sharply, and this forces short sellers who bet on it to basically decrease in value to buy the stock to cover the losses and basically to reduce them as much as possible. When they buy the stock, this adds further upward pressure. And so basically, short sellers are squeezed out of their position. And that's where it comes from, the concept of short squeeze. Because they're forced to buy their positions, they're forced to exit them, and so they're squeezed out of their short sell positions. And an important example here was Tesla, who was an extremely shorted stock, and the price rose 400%, and in that instance, short sellers lost big. When considering short selling and short squeeze, some important key concepts are, firstly, short interest ratio. This is the total number of shares shorted compared to the total shares which are floating on the market. And this is also referred to as short float. So if you hear that, you know what it means. A second point is short interest to volume ratio. This is the total number of shares sold short divided by the stock's average daily trading volume. And this is also known as days to cover. So these are very important concepts because if we have a high short interest ratio or days to cover, this may mean that the stock is overvalued in the eyes of the investors. So it gives us some insight into what their thoughts are in relation to a particular stock. Then there's obviously pros and cons which you should always consider when discussing short selling and short squeezing. Some key pros are high profits, because if investors have picked the right stock and the price declines, they're in to make potentially high profits depending on how much money they put in. There's low capital needed, meaning they can put as little money as they want. There's also leveraged investments, so they can increase their wins by borrowing, for example, 200k. They'd make more money with that money borrowed, if it plays out well, obviously, than by only putting 20k. And then there's obviously cons. So disadvantages that there's technically unlimited losses, meaning there's no ceiling on how high a share price can go, as we said, and so there's an unlimited amount of losses they can make technically, unless they obviously cut their losses as they usually do. And this leads us on to the short squeeze, which is said, so this is when they cut their losses and the price keeps rising up sharply. And then there's also margin interest, which is the interest payable on short trades. So regardless, it's a cost that investors in this case have to keep in mind. And a very interesting case which you can refer to is the Volkswagen super squeeze, as we've called it, of 2008. In this case, Porsche was aiming to gain a majority control of Volkswagen, and investors were heavily shorted on the stock because they expected, following this, that the share price would fall. Porsche had secretly bought 70% of the company, many investors did not know this, and 20% was owned by a government entity. meaning very few shares were available on the market. Shorts had to cover their positions to cut the losses, and the price spiked from $200, as you can see on the graph, to over $1,000, meaning that for that time frame, Volkswagen was the most valuable company in the world. And this was a very interesting case because it also reflects a bit what we've seen with GameStop recently, as you can see also from the graphs, which are fairly similar. You probably heard a lot about it in the news, so I won't go into much detail, but the basics of it was that hedge funds felt GameStop was a struggling business, and so they heavily shorted it. On the social media Reddit, users instead countered this position and started buying shares. They knew they had a huge short interest on this stock, and so they were aiming for a short squeeze. In fact, as you can see here, short interest was 139.67% of the float as of the 21st of January. This was more than double the next highest level of any stock in the Russell 3000 index, according to data from S3 Partners. And as you can see on the graph, the price exponentially spiked as short sellers were forced to cut their losses and buy back the shares. We're going to move into a bit more technical things in relation to something called the gamma squeeze. But before we do this, some essential definitions are here. Firstly, options. Options are derivatives that allow buyers to buy or sell the underlying asset, for example, a stock, at an agreed price and date. So for example, I agree to buy a share in TBU at £20 on the 15th of March. But now delta, this is a factor that shows the rate of change of the option's price per the change in the underlying asset's price. So for example, a delta of 0.50 means the option price will increase 50 cents for every $1 in the stock. Lastly, we have gamma. This is the rate of change between an option's delta and the underlying asset's price. This may be a bit technical, but it serves importantly to discuss gamma squeeze. And this is when a market maker sells call options. And call options are when the holder gains the right to buy the asset at a stated price within the specific time frame. Very different from put options, which is when the holder gains the right to sell the asset at a specific price within a specific time frame. So in this case, in this scenario, buyer is long gamma and long delta, whilst the market maker is short on both cases. So the market maker then hedges its business by buying stock, because this results in positive delta to counter its current negative delta. Obviously, the market maker is focused on commissions, and this increased number of people buying the stock results in a continuous rise in price, as you can see on this little graph we've got here. And that's what's technically referred to as a gamma squeeze. Now, we hope you found this video clear and helpful, but obviously if you have any questions, please do not hesitate to drop in the comments and we'll be more than happy to help. Let us know what you'd like us to cover in the next video too, and we'll be happy to do that because we want these videos to obviously be as helpful as possible for you guys. And if you enjoyed it, please leave a like and subscribe if you'd like. We'd love to have you on board. And remember not to miss out on grabbing your free month of the legal update now on our website. Gain a whole month of exclusive access to all our legal news, resources, interviews, you name it, as much as useful stuff as we got there, and it's all free for a month. So if you want to give it a go, just visit our website and we'd love to have you on board there too. We hope you found this video useful, and see you next time.